Accrual accounting, cash accounting. What is that? Hey taxpayers, it's Tiffany Gonzalez, CPA here, founder and CEO of Accounting to Scale, and we're back with another installment of What is that? Where we break down financial terms and make them easy for you to understand. Today, we're talking about one of my favorite topics, accounting. In particular, two methods, the cash method and the accrual method. So stay tuned as we start right at the beginning. An accounting method refers to the rules that a company follows when recording income and expenses. The two primary methods are cash basis accounting and accrual basis accounting. And the difference between the two has to do primarily with timing. The timing in which you record the income and the timing in which you record the expenses. Like everything in life, timing is everything. Let's start with cash accounting. It's relatively simple. Basically, a business records income and expenses as they actually incur. So, whenever the income comes in, that's when it's recorded. Whenever the expenses go out, that's when it's recorded. Because it's so easy, it's so widely used. In fact, most of us use the cash accounting method when managing our personal finances. It's an appropriate accounting method for most businesses of a certain size and a certain industry. But once a business starts to get more complex, where the revenues are much higher, maybe in the multi-million-dollar mark, maybe they have some inventory and some receivables, now it's time to start using the accrual method of accounting. Before we move on to the accrual accounting method, let's talk about the main drawbacks of the cash accounting method. While it is really simple to use, the main drawback is that it may not accurately present your financials. For example, if you aren't accounting for bills that you'll have to pay in the future, you might appear to be more profitable than you actually are. If you aren't accounting for income that you're going to receive, then your revenue might be stated lower than it actually is. Cash accounting can either overstate or understate a set of financials depending on whether the business had low or high accounts receivable or accounts payable in any given period. Now let's talk about the accrual accounting method. Accrual accounting has to do with the matching principle. Essentially, you're matching the expenses with the income. By matching your revenue with your expenses, you will get a clearer picture of your financial condition. Under the accrual method, transactions are recorded when they are incurred. What does that mean? It means that if you expect income to come in, an invoice is created, you have an accounts receivable on your balance sheet, and you have the revenue on your income statement. If you want more information on how to read financial statements, click the card right over here to learn more. This method of accounting can be perceived as tedious, so it is beneficial for a company that is more complex or larger. The modified cash basis accounting method is a hybrid. It's not something you use on your tax return, but it is something that can be used in managerial financial statements. Basically, what it means is you accrue some income and some expenses, but not all of them. Because it's not as strict as the full accrual accounting method, it can be a little bit easier to use than the full accrual accounting method, but still present a better financial picture than just the fully cash basis accounting method. Determining what accounting method to use is an important conversation to have with your CPA. We would love to have that conversation with you. We hope you enjoyed this latest installment of What is that? Please hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.